Hey guys, and welcome to today's video. So in today's video, we're going to be discussing market structure or liquidity grab. So probably most of us has actually taken trades, and we've struggled between identifying the difference between if the market has given us a market structure or if that is just a liquidity grab. So in today's video, I'm going to be sharing with you ideas on how you can be able to differentiate between a market structure shift or a liquidity grab. So without further ado, let's get right into it. So let's say you are looking in price action and you see um, price has done something like this already. So let's say you just stepped into the forex chart, you are about to trade and you see something like this. So one of the things you want to pay attention to is you want to pay attention to the liquidity run that's just happened. So you spot the liquidity run, and the next you want to spot is the equal highs on the buy side, which is the buy side liquidity. So now you have a liquidity run and you have a buy side liquidity. So you are waiting at this particular liquidity run, which is the current market price, to see what price does in that area. And price does this. Now price gave us an impulse move right here. All this price leg here is an impulse move to the buy side, taking out this particular high, giving us a market structure sheet. So now you can right here, you can see we identify our fair value gap, an area that we want to see price trade back to for our area of entry, and see if price will get to this particular area of target, which is the equal highs and the buy side liquidity. So we saw that also going forward that there is also a liquidity target right here that is a near term just before this particular equal highs right here, which is also the ultimate buy side liquidity. So we have something here on the near term. So moving forward in price, we saw price do something like this, come into this particular fair value gap, and that gave us our first entry. We took that particular trade to this first area of target right here, which becomes our break of structure, which was formerly a area of liquidity, but now becomes our break of structure. That's very, very good. So moving forward in price, we saw another opportunity right here, which is another fair value gap just after this particular break of structure, and that gave us our another entry. And now we are aiming for this particular equal highs or buy side liquidity. And there are other highs here, but let's see if we can just aim directly for that particular equal highs. And ultimately, we saw price drive aggressively right there into that particular equal highs. We would have taken partials around this area, which most of us is going to do, but since we've already identified these equal highs, there's a strong pool of liquidity to that particular area. So now we've identified price in the right direction all the way from this particular liquidity run right here. After this market structure, we've been seeing price give us an institutional order flow to the buy side, and we've practically made profits all the way from this particular liquidity run all the way to that equal high buy side liquidity. But all of a sudden, price does this. Now, wow, this is a very, very interesting move right here. A lot of us is like, wow, finally we are going to see what selling, what opportunities. And now seeing that price gave us this impulse leg from an very, very sensitive area, which is an equal high, which is you can say, okay, our price just what collected liquidity around this area. It has trapped um, buyers that are trying to buy right here. So it trapped them and also took out sellers they were selling right here. So this impulse strong momentum right here give us an indication, oh, price wants to start what going lower. And all of a sudden we identify what a market structure shift. I was so excited to start selling. So we set our area of our zone of entry, which is the main threshold of this up close candle, and we saw our price traded back into it. I was so excited to take our shot at that area. So we enter a sell at that particular area. Kaboom! We saw price go against us, and that becomes a loss. And we are like, wow, wow, wow. A lot of us are going wild in our mind and being very annoyed and wondering why this particular market structure shift failed. This one became positive, this one failed, and it's almost like the same kind of scenario because we saw a liquidity run here from this sell side giving us a market structure shift, and now we also saw a liquidity run to the buy side giving us also a market structure shift, but this particular one here on the buy side didn't hold true. So there are two ways to be able to spot if a market structure shift is going to hold true or whether that particular move is just a liquidity grab. Like you can see here on the buy side, this whole move below this particular low, this wasn't a market structure shift. This was just a liquidity grab. Price just came down for this particular liquidity, paired that particular liquidity and used it to buy all the way to the buy side. But right here, this particular high right here, price trade above it, breaking past this high, making here what a market structure shift. So this is a liquidity grab right here. This is a market structure shift. So what is the first way you can be able to identify the difference between a liquidity grab and a market structure shift? Now, this one right here is a market structure shift because you can see the impulsiveness of the candle. So price displaced above this particular high. So one way you can be able to identify market structure shift is that you want to see a displacement above a particular high, not just a weak throw. Like you can see this one here, the price came down impulsively, but didn't really displace below this low. So you can see here we are starting to see the bodies of this candle displacing aggressively. And one way I like saying it is if you take the bodies of these candles, the body of these down candles and the body of these up candles, and get their pips measurements and divide them, you should be able to get a ratio of 1.5 or 2%. You get what I'm saying? So it should be able to give you a ratio of 1.5 or 2%. Good. And if you do the same thing with this particular up series of up close candles body and series of down close candle body, you should be able to also arrive at the same 1.5 or 2.5 or 2%. But this won't give you that. This will rarely give you 1. So this doesn't qualify as a displacement in price. This is just a ritual. But this one actually here, if you divide the amount of pips you get on this down close candle and the amount of pips you get on this up close candles, they are going to be able to give you 1.5 or 2x%. So that is one way you can be able to identify the difference between a market structure shift or a liquidity grab. So don't forget, we have displacement above this particular high. The momentum of the candle is bullish and close aggressively above this high. So here is a market structure shift. But here you can see the limitedness of this particular candle. It failed to displace very well below this particular low. So here doesn't serve as a market structure shift. It's actually what a liquidity grab. So another way again you can be able to identify the difference between a liquidity grab or a market structure shift is what I call institutional price swings or institutional price movements. So you want to be able to understand the pattern flow of the marketplace. You want to be able to understand that price moves in swings and ranges. So, and when you identify a piece of price action just like this, you have the equal highs to the buy side and a liquidity run to the sell side, and you have something of this kind of sort here. This is an intermediate price swing. Now here serves as an intermediate price swings because of we have a swing high here, but we have a swing high right here to the left side of this place, and we have a swing high right here to the right side of this particular price swing. So this particular high here serves as an intermediate price swing because that's going to be the first draw on liquidity we have even before price gets to this particular equal high. So we can see that the price all the way from this particular liquidity will run aggressively right there all the way to that particular high. So what you want to do if you're trading this live, you want to identify that intermediate price swing because that's going to act as an area of support if price is going to be coming down. So that's going to be at a very significant area. So you want to mark that out in time. So because it's going to take a whole degree of momentum to be able to break past this particular swing. So because this particular area was once a resistance level. Now applying support and resistance idea that you got from retail-minded approaches. You know what I'm saying? So here we saw price move from this particular low all the way to this particular area, taking this particular high right here, and we saw our price move aggressively to this particular low. So this particular high, the push of this particular candle took out this high, took out this high, and took out this high. So for it to come down, it took a great deal of push, whereas momentum from this particular area to be able to get to this particular low, creating highs, highs, and highs. So here is an intermediate price swing. So this particular area is going to be key in price. The market maker is going to be looking at areas like this to be able to act as strong zones or strong levels in the marketplace. So you can see that from that particular area, we saw price move aggressively all the way to the buy side. You see, price didn't really come down to retrace deeper. Price just retraced lower into this particular fair value gap and keyed off of this particular zone, this particular level, and kept on pushing higher. That's to tell you how significant this particular area right here. So this is an institutional swing points in price you get, or an intermediate price swing. So now moving forward in price, you saw something like this, and you are tempted to identify here as a market structures swing. You shouldn't. Why? Because just close to this particular movement lower, you have what? An institutional price swing. Unless this particular move downwards breaks, displacing past this particular institutional price swing, this particular sell is not valid. So you don't want to view this push down right here as what? An institutional, as a market structure shift or an impulse down. Instead, you rather view here as a liquidity grab. And we already know from the benefit of hindsight and with the example I've showed earlier, going forward, you can save yourself a great deal of losses, because a lot of us would have gone probably keying off from lower time frames or using this particular order block, and we'll be setting our risks to the world just in this fashion, trying to collect it below these equal lows right here, or this particular fair value gap. But you can see what price did. Price went all the way the other direction. Why? Because there is what? An intermediate price swing that price did not break or displaced pass through. So you want to see price, if price is really going to go down, price has to displace aggressively past this particular swing high right here. So I want to know if you found value in today's video. If you do, hit the like button, hit the subscribe button. You can leave your thoughts in the comment section. Probably you want me to go over more examples using this particular concept and teaching you more about market structure shifts and the difference between a liquidity grab. You can also leave that thought also in the comment section. Until next time, see you in more videos.